Good afternoon, traders and investors. Will back here with another one, coming to you with a Monday market update. Hope everybody had a beautiful weekend. So in today's markets, guys, the bulls cooling off a little bit and rotation to the downside across most of our major sectors here. SPY, QQQ, financials, and healthcare took a little bit of a dive lower. So are we finally due for some of that seasonality consolidation, guys? Keep in mind, we've been talking about this for a while now. We did not get the end of February sell-off as expected. There are a few remaining trading days in February, but for the most part, looks like February will end the month green. Now, March is known to be a regularly negative month for the S&P 500. So will this be a little bit of a period of sell-off before we get some CPI news in about 2 weeks, and then Jerome Powell's meeting on March the 20th for the interest rate decision? That is something that we're going to be keeping a very close eye on. For the news this week, we only have one big piece of data coming out on Thursday, which is going to be your PCE inflation report. That's the Federal Reserve's preferred inflation report. So we'll see what is happening with the progression of goods and services in the PCE report for the month of January, as CPI, PPI were namely hot. So we already have two hot reports for January. Will the PCE show the same thing? And could that lead the markets into more of a negative decline? These are the things we're looking out for on the week, guys. So we're going to be keeping a very, very close eye on our markets. Keep an eye on this rejection from our trend line, SPY and QQQ as well. Could we potentially be setting up for the daily downtrend? We're going to look at that when we take a look at the technical analysis on our major markets. Before that, though, we are going to cover a couple of subscriber requests. We have two earnings calls for you guys. We're going to do Verisign number 1, and number 2, we're going to do Toll Brothers. These are subscriber requests, guys. Always remember, if you have any requests for me, I would love to cover them on the channel, whatever they may be. In this case, we have a few. Number 1 from Wissam. Can you please give us a brief analysis on SMCI? Thanks in advance. We'll do SMCI technical analysis at the end of the video after PayPal. I'll leave the timestamp down below in the comments. It'll be towards the end of the video. Number 2, Varshpat6378 asks, can you take a look at TOL? Feels like a great long-term buy. Also, the Intel comment we did last Friday. So if you didn't see that Intel analysis, that was on last Friday's video. Toll Brothers will do their earnings right now together. And lastly, Rashid asks, thanks for the great content. Can you please review Verisign? Verisign, one of Warren Buffett's holdings that he's been holding since 2012, 2013. Very solid company. So we're going to go through their earnings as well. They had earnings about 2 weeks ago. Just before we jump into that, let's take a quick look at our heat map, since we did have a relatively negative day. And you'll see that to the downside in terms of big tech, guys, led down by Google. Now, Google has had a few little mishaps as of lately in terms of their generative AI software called Gemini. We're going to look into those negative news headlines when we do the technical analysis part on Google later on in the video, but they were the loss leader in big tech for the day. But for the most part, guys, pretty much a large day of consolidation across the board. Tesla finally getting a little bit of love and outperformance, but across the board, guys, really a big day of consolidations. Healthcare, financials, and your major tech sectors selling off. On the one-day relative performance, you can see this even better. Technology, consumer cyclical, ever so slightly green, but everything starting the week pretty much in the red. So we'll continue to keep an eye, guys. Can the rotation stay healthy? While QQQ takes a little bit of a dip, are financials and healthcare going to continue marching forward, or are even financials and healthcare due for a little bit of weekly consolidation, which would be extended weekly consolidation for the entire market? XLF and financials and healthcare have been doing a great job of keeping the market afloat ever since QQQ has been pretty much flat for the past couple of weeks, but they can't hold it up forever. Even they will need to consolidate at a certain point. And with March seasonality, this could be the perfect time for a little bit of consolidation, aka a very decent dip buying opportunity after the recent euphoria in big tech. NVIDIA earnings, all of that is now behind us. No major catalysts except for the one on Thursday, PCE inflation. No major catalysts for the next 2-3 weeks. Could be a good point in time for a bit of consolidation. So we'll take a further look at that when we go through our technical analysis here on the indexes. But first, before that, let us do some earnings. And we're going to start it off with a company that I don't talk about much on the channel, but this is just a very solid company, guys. It's Verisign. So Verisign, if you guys don't know what they do, they are pretty much one of the industry leaders, actually probably the biggest market leader here in DNS, so domain name services for .com and .net ventures here. So whenever you want to register a website for .com and .net, you can go to Verisign to do that, and they'll obviously charge you a fee for managing that domain. Now, they are more oriented to a business-to-business solutions. So you'll see a few of their partners here in terms of Verisign. You'll see that a lot of their partners, right? You have some partners like H&M, IKEA, Tiffany & Co., New York Times, Adidas.com. So all of their websites are Salesforce, a couple more up here, IBM. A lot of your major businesses, guys, have their websites hosted by Verisign, not only because they're one of the industry leaders, but also because they do offer integrated cybersecurity protection. Very solid company, guys. It's not really a flashy company, but they get the job done. Keep an eye on their technicals here as well. They've been accumulating in this wide range, pretty much 190, current share price roughly all the way up to about $230 for the past couple of years, pretty much for the past 4 years at this point, as they grow into their new valuation. The valuation really isn't that bad right now. It's trading roughly at fair value. I could see some upside all the way up to about 220, 230 over the next 6 to 12 months. Now, a few of the headlines here, guys. So they're the market leader, BRK.B. So this is Berkshire Hathaway. They've been holding them since 2013, since the company was worth about $50 per share, all the way back down here. Now, take a look at the holdings. This is the Berkshire Hathaway holdings for the entire company. You'll see that they're fairly up there. They're about top 15 positions, right? Warren Buffett's portfolio only weighing about 0.7%, but they do have about $2.5 billion of exposure in the company, never really selling any, just holding it, right? So anytime Warren Buffett chooses to hold a stock, he's kind of agreeing to buy more at the current price, or if not, he would be selling. So it does show that he still finds value within this stock. Now, they have extremely high net margins, guys. Take a look at these yearly net margins, always ranging between the 50 to 60% range, an extremely easy business to run in terms of free cash flow and net margins, guys. This just doesn't cost them a lot of money to manage their operations. When they're charging customers, let's say $10, $12 for domain name registration or something like that, plus upkeep fees, it really doesn't cost them anything to do that on their side. That's why these margins are so extremely high. It's a recurring subscription-based model as well. So very, very solid business model. They have decent free cash flow, low amounts of debt. Let's take a very quick glance at their debt right down here. You'll see that they're into the year with about $1.8 billion in debt, and cash equivalents is only about $240 million, but they do pump almost $1 billion in free cash flow, about $800 million in free cash flow per year. So debt is really not a problem for this company at all. It's just a very solid company, guys. Nothing fancy about the company, nothing sexy per se. It's just, they just continue increasing EPS. They just continue increasing revenue every single year, right? Every single year, revenue, EPS expansion. And with the extra free cash flow, they just buy back shares for the investors. So they have very good buybacks, low shareholder compensation, two things that I want to see in a company. Take a look at their buybacks. Look at their shares outstanding since 2010, guys. They were about 200 million shares back here in 2009, and they've cut that in half. So they pretty much bought half of their entire float back over the past 13, 14 years at this point. So very, very good use of capital by the company. Their revenue growth for the foreseeable future for the next couple of years is not that high at about 6%. The industry standard for IT plays is about 10%. This is a more mature company out of its growth phase. They're just pretty much in a maintenance phase right now and just running a very solid software as a service company. Their EPS growth, however, is very, very good, as their revenue is increasing ever so slightly, but their costs always usually remain fixed. Their costs really don't grow that much, and I'll show you that when we go through their numbers here in a bit. Their PEG ratio for 2024 is sitting about a 2.5, so a little bit rich for me in terms of the growth that they have. But in terms of that, regarding their guidance and everything, there's really no red flags for the company. The company has traded at these PE ratios. You can see right now, it's trading at about a 25 PE ratio, and the EPS growth has always been about 10% per year. So they've been trading at this PEG ratio for a number of years now. So it's not as if you're ever getting a tremendous discount other than this period back here in 2022. And you can see this is the Verisign PE ratio history for the past 13 years roughly. And you can see it's pretty much average. It's actually lower than where it was just a few years back. You can see sometimes it peaks into the 30s and 40s, but for the most part, they're used to having a mid 20s to high 20s PE ratio. So the valuation in terms of that is fairly fair. They've just always been trading surrounding these metrics here. Now, Let's go over some of their earnings and I'll show you guys why this is such a very solid company. They just perform extremely well in the business that they run. And compared to GoDaddy.com, let's say, GoDaddy.com is one of their largest competitors, but GoDaddy.com is more oriented to small businesses or consumers. This is more of a B2B, business to business application for web hosting and domain name registration services, right? So take a look at this capital allocation, free cash flow of $808 million in 2023. Very good. And you can see what they do with their free cash flow. So the free cash flow is in green and then your share repurchases are in blue. And you can see that they really don't like keeping any cash on hand. They just use all of that cash, even sometimes dipping into prior quarters free cash flow to just buy back more and more shares. So extremely good cost management, or not cost management, but extremely good cash management by the company in terms of returning that to the shareholder. Here's some of our business highlights. So domain name bases here, about 172 million names. You can see a steady little uptick here, although it's been peaking over the past year. They did lose a little bit on a quarter-over-quarter basis, about 1.2 million names. But for the most part, guys, no red flags in their business, not growing as fast as you'd like to see, but at least they are maintaining their current subscription rates with their existing clients, and their existing clients are so large and whatnot that there's really nothing to say that's bad about this company. I don't see this company netly dropping off either in domain name registrations. They've been known as one of the industry leaders for the past 10 years, and I do expect that to continue, guys. Now, in terms of their more business highlights, so we have new name registrations of about 9 million on a quarter-over-quarter basis. So even though their yearly basis was roughly flat here, on a quarter since Q3 to Q4, we did have a slight little uptick here. And you can see they usually just maintain the same renewal rate, right? So take a look at this renewal rate all throughout the quarters here, all throughout the past 5 years of data, depending on their quarter. The renewal rate is always about 73 to 75%. So nothing really changing there in terms of that. Financial performance, revenue, 1.49 billion. You can see, as we saw on the trading view charts, just steady increase in revenue, steady increase in operating income as they're able to keep those expenses relatively flat while just ever so slightly increasing revenue. That's the real value in this company per se. And here you can see that expressed even better in terms of their revenue versus operating income for the quarter. Just looking at a quarter-over-quarter basis rather than a yearly basis, you can see really streamlined growth. No outlier quarters, right? You can't see one quarter where they netly drop off. So that's exactly what you want to see. This company is predictable. It's consistent. They have high net margins. Really nothing bad to say at all. Now, here's the guidance. So domain-based growth will be roughly flat for the year. As we were seeing, they're going to maintain that trend that they had over the past couple years as well. So the new name registration should be fairly flat, but then again, they do have recurring subscription revenue, so that shouldn't be hurting them too much. It's not really a top line growth company per se. It's really just maintaining the current customer base and just ever so slightly increasing that over time while maintaining extremely good margins here. Their revenue increase forecast to about 1.57 billion. And you can see in the past year, guys, they've brought in, roughly 1.5 billion. So that's going to be a slight little increase up to about 1.57 billion. So really standard revenue growth here over the next couple of years. As I said, just about 6%. Nothing bad to say about the company whatsoever. So some decent guidance, no red flags there whatsoever. Right, so if you take a look at some of their financial statements, just for some furthermore headlines and just to prove to you guys what a solid business this company really is, as of December 31st, there's still about $1.12 billion remaining for future share repurchases under the plan, which has no designated date to stop. So this company currently is worth about $19 billion. So 1.2 billion of that, 1.2 billion divided by 19.48 is roughly still about a 6% of buybacks that they can do against the outstanding float. Very, very good for them to be able to continuously do that. A lot of these gains over the past couple of years, guys, have been due to those share buybacks. So it's nice to see that they just continue doing that. And now Verisign announces as well that it will increase the annual registry level wholesale fee for each new and renewal.com domain name registration from $9.59 to $10.26. So you guys remember when I showed you that their new registrations are going to be relatively flat for 2024. However, they are going to increase these prices significantly, right? By by approximately about 6-7%. So a lot of that revenue growth is really coming from their ability to just increase prices and maintain the same amount of clients. That's what one of the benefits of this company is. When they're not generating new business, they can just increase the prices of existing business. And since it's such an incremental increase for most people will just be agreeing to pay this incremental increase. Reminds me a bit of Netflix, right? How they can just increase their subscription plan from $15 to $16. Now, it may not seem like a lot of a big price increase to most people, but when you have in terms of Netflix, right? When you have over 400 million customers, $1 a piece, that's an extra $400 million to the bottom line. So this company pretty much operating under the same guidelines here. No real red flags despite that slight little dip in revenue. And this is a company, guys, I just want to show you how solid this company's balance sheet, and then we're going to go through their income statement truly is. They're really one of a kind here. So if we take a look at their balance sheet, just to show you guys that they don't really have much debt at all, take a look, total current assets, so that's cash and cash equivalents, plus their investments that they may have made, $988 million. Again, some long-term senior debt here of about $1.8 billion. So roughly running about a 50% cash versus long-term debt. That's very, very solid, guys. Nothing wrong with their balance sheet whatsoever. Just very, very solid company. In terms of your revenue increase, you can see that over the year end 2023 to 2022, bump in revenue by about 4.8%. That's good. Now let's check if the company has operating leverage. Are their revenues growing faster than their combination of expenses? Well, here you can see revenue growth of about 4.8% year over year. Their operating expenses, so costs and expenses of the revenues here, is only about 2% on a year over year basis. So revenue far outpacing the cost of the goods sold. And in terms of their net income, very good as well. Net income bump here of about 21% with back to net margins of about 55%. So that's very, very good. They're really returning to how much net margins they had previously in 2020, 2021. Really high 50%. Last year was a bit of a dip here at about 47. Sorry, you guys can't see with my big head in the way here. So net margins about 47%. Now back up to roughly just over 55%. So that's extremely good for the company, able to be recapturing their net margins like that. So very, very good, guys. Nothing bad to say about this company at all. And here's one last thing that I show you guys all the time because of how important it is. It's your stock-based compensation. So this company is making a lot of money, obviously, but are they using that free cash flow to pay themselves in terms of stock-based compensation for management and executives, or are they paying it back to you in terms of share buybacks? Well, if it wasn't obvious from the beginning of our discussion, most of it goes to share buybacks, but look how much they pay themselves, guys. Only $59.7 million of stock-based compensation. That is only 4% of their total revenue. That's exactly what I want to see personally. Anything under 10% is good. Under 5% is absolutely amazing. And usually when you see these mature companies that are extremely well run, extremely well managed, that's what they'll usually have, anywhere between under 5 to 10% as a total stock-based compensation, as an expression of their total revenue. So Verisign, it is a decent company for me, guys. I would consider taking a swing trade right around here. 190 is roughly fair value, and I do believe that we could see the 220, 230 level play off for them in the future. No problem with that. It's a decent little swing trade. This whole accumulation zone from the bottom to the top for a swing trade really reminds me of another very, very, very nice company in the name of CP. You guys may remember me playing this one a bunch down here, guys. These are just very solid companies, very decent margins, well-run management teams that when they get to a lower end of an accumulation range, it's just a very easy trade because you know you have solid fundamentals backing up the company. So I really would not be opposed to making a little bit of a swing trade here, all the way up to potentially $230, $240. $230, $240 really puts them pretty much at next year's expected earnings per share and PE ratio. If we were to take them on a constant valuation basis, that's where the stock price should end up next year, about $220, $230. And if you take a look at most analyst targets, that's also what they're forecasting here, anything between $220 and about $230 for a little bit of a swing trade. So there is a bit of meat on the bone on this one. Nothing bad to say with the company. Absolutely beautiful company. And the second one that we're going to be taking a look at, guys, is Toll Brothers. So Toll Brothers, we haven't taken a look at any of the home builders over the course of this earnings cycle. Let's do Toll Brothers together. If you remember from last quarterly earnings, we were talking about the narrative behind the home builders. So if you don't know why the home builders have run so much, guys, it really comes down to existing home inventory on the market. So obviously when interest rates are high, not a lot of people want to sell their homes because it becomes difficult for them to buy another home, especially at a 7% interest rate. So if you've been having a 3, 4, 5% interest rate for the past 10, 15 years, and you're looking to sell your house, well, the new interest rates, guys, are about 7, 8, 9%, depending on your credit score. So it's tough for people to leave their old house, buy a new house that's more expensive and at a higher interest rate. So your existing home inventory is relatively down, and we can see that right here, guys. Here's your US existing home inventory from 1999. Now, just let's focus on this area down here. So I want to bring your attention, whoops, that's a bit too much. I want to bring your attention really down here to where we are right now. So you can see after the pandemic, when rates got super cheap, your US existing home inventory absolutely plummeted. Everybody was going out and buying new homes. Now, February 2022, the bottom right here, is when the Federal Reserve started increasing interest rates. And you can see that increase in interest rates did slow the demand for homes a little bit, but still, it's still all the way down here. Existing home inventory is still relatively low to even what we had prior to the pandemic all the way about here. It's actually cut pretty much in half. So the inventory is really low right now, which gives companies like Toll Brothers who build new homes a bit of an advantage, right? Because if you don't have a good supply of existing homes, then buyers will resort to new build homes and have companies like Toll Brothers build the homes for them. So they're kind of replacing the lack of demand in the market for existing homes and replacing it with supply of new homes, So Toll Brothers, they're the luxury home builder leader, and they're actually a very beautiful company, guys. The products that they design, the homes that they design, are usually modern, sleek, and more oriented towards a luxury client, as you can see from these pictures right here. Very, very solid company. Now, let's get into some of their earnings. You can see that in terms of their earnings, they did have a double beat on earnings, beat by about 26% on EPS, which is not small, and they did beat by about 4% on revenue as well. Very, very solid numbers in terms of an earning beat. Company is trading at the all-time highs right now with no signs of slowing down. So we'll take a look at their financials and see, is the valuation sustainable? They do have a low amount of debt in relation to the type of business that they run. So you would expect a home builder who usually runs a lot of different inventory, has to take out a lot of loans to purchase a lot of land. You would expect them to maybe have a bit too high debt, but that's actually not the case. You can see they just reported on a yearly basis, right? Only $3 billion of debt, $1.3 billion in cash and cash equivalents, and they bring in about $1 billion of free cash flow per year. So this amount of debt is really low compared to the cash that they bring in and the cash they already have on hand. Decent free cash flow, as we just saw. They just put out, guys, extremely solid 2024 guidance. So we'll take a look at that. EPS growth is about 8% through 2024, but that is where it stops. And this is going to be one thing we talk about when we do Toll Brothers. Take a look at this EPS growth for the next 3 years. You can see roughly flat against 2023. So could the home builders potentially be becoming close to the end part of their expansionary cycle? That is something huge we're going to be taking a closer look at. So let's take a look at some of their headlines. Toll Brothers stock is having a good year. The reason lies in who buys its homes. And you're going to find a little bit of a parallel here with my investment in Louis Vuitton. So one of the biggest advantages Toll has over its competitors is a relatively affluent base of buyers who are less affected by mortgage rate volatility, according to analysts. The company, which bills itself as America's luxury home builder, said in its most recent quarterly results that 25% of buyers paid all cash for its homes. I did not know this personally, which had an average price tag of over $1 million. That's huge, guys. 25% of buyers coming in for all cash for over $1 million in average home price. That is substantial. Now, here's what an analyst had to say about this. We view Toll Brothers' target consumer as lifting the company's performance when compared to peers. We think that luxury consumers are less influenced by what rates are doing, as they tend to be better capitalized, which provides them more options to offset rate headwinds. As I said, guys, in recessions, rich people don't lose money and usually don't stop spending. Another one of the reasons that I've chosen to invest in Louis Vuitton stock during this year as well. Now, Toll reported a 40% gain in orders year over year. That's massive. In its fiscal first quarter ending January 31st, and raised its guidance for home deliveries for the full year. When looking at the most recent reporting quarter, we see that on a 2-year look back period, we see home closures volume flat for Toll Brothers, whereas home builders with more exposure to entry-level consumers, basically consumers with less access to capital, have seen some double-digit declines in home closings. So apparently Toll Brothers still able to keep demand strong because they target a more luxury consumer, whereas some of the other home builders that target less affluent consumers, well, they have been having a reduction in demand, something that Toll Brothers has not had. Additionally, average selling prices for Toll have jumped 14.5%, whereas peers have come in below that and some have been negative. Now, here's a key point that we have to look at for Toll Brothers and other home builders. She added that Toll's growth margins over the 2-year period have also outperformed peers who are more exposed to first-time home buyers. Here's the key, guys. Toll has been less reliant than others on incentives, known as mortgage rate buydowns, where builders cover a portion of the interest rate buyers pay on a loan. Wall Street is concerned the practice hurts builder profit margins. This is basically if the market interest rate to go buy a home right now is 7, 8, 9%, these home builders, to stimulate demand, they're going to do a bit like what Tesla is doing right now to stimulate demand for cars. They will subsidize your interest rate. They'll say, listen, you want to buy a home from us? We'll give you an interest rate of 4 or 5%, which is under the market rate. So they're willing to take a hit on an interest rate just to get their product out the door. It's the same strategy that Tesla is using. That's a demand stimulation strategy. So Toll Brothers, because of the fact that their demand is strong, they don't have to do that as much as other corporations such as D.R. Horton or Lennar Corporation, some of their biggest competitors, are doing. That is a huge positive for the company. While mortgage rate buydowns are heavily marketed and offered nationwide, very few of our buyers use incentive dollars to buy down their rates. This was said by the CEO. The vast majority of our customers can qualify for a market rate mortgage without a buydown, and they prefer instead to use any incentive offered on design studio upgrades or to reduce their closing costs. So the consumers don't care about interest rate incentives. They would rather spend the money on upgrades for the company. And when they do that, well, that's more money in the company's pocket, not taking out money from losing on interest rate margins because they're subsidizing the consumer. So very solid report from Toll Brothers. My only gripe with this stock right now is that the upside at this point in time is coming to an end. I believe that the cyclical nature of this trade is potentially coming to an end, guys. Once the housing market really takes a little bit of a slowdown here later on in the year, we know how long they lag. When interest rates start coming down, what's going to happen is that inventory of existing homes, not new build homes, is going to progressively start flooding the market. So it's very possible that this company will not be able to consistently deliver the amount of growth it has been in the past couple of years. And that's why we have a relatively flat expectation for EPS, because they're kind of peaking in their cycle before existing home inventory gets back on the market when rates start coming lower. And even their revenue, you can see revenue roughly going to be flat over the next couple of years in relation to the past 2 years. So really nearing the end of its cycle. Now, that being said, the company is extremely solid. Now let's take a look at some of their headlines. Backlog value was $7 billion, down 18%. That's just because they've been selling inventory. So homes in backlog were down by about 6,700 homes, down about 13%. So that's fine, guys. They still have a backlog inventory of about $7 billion. This is a company that makes roughly about, $9 billion, $10 billion per year. So they roughly have just under 1 year of backlog inventory in terms of annual revenue that they can collect. Now, here's something good. SG&A, selling, general, and administrative expenses. So the miscellaneous costs related to running their business as a percentage of home sales revenue was 11.9 compared to 12.1. So they brought their administrative and sales expenses down a little bit. So their revenue was up, but their sales expenses were down. So that's why their profit margins had a little bit of expansion. Now, further comments by the CEO, we experienced another quarter of solid demand. Here's your guidance for 2024, very important. We signed 22,000 contracts for $2.6 billion, perfect, up 40% in units and 42% in dollars compared to last year's first quarter. Since mid-January, here's the guidance. We have seen a marked increase in demand coinciding with the start of the spring selling season, with a healthy job market, improving consumer sentiment, and continued low levels of resale inventory. As we've been talking about, we are optimistic that demand for new homes will remain strong in 2024. Based on our first quarter results and with strong start to the spring selling season, we are raising our full year guidance across all key metrics. So 2024, potentially one of the last good years for the home builders before existing home inventory starts piling onto the markets. Now, here's your fiscal year 2024 guidance. So in terms of deliveries, they're looking at about 10,000 to 10,500. That's roughly in line with their 2022 and 2023 numbers. So record years for Toll Brothers, nothing bad to say there. However, the average delivered price per home will be dropping as an average into 2024. So they may be expecting that inventory of existing homes coming onto the market, which is going to bring down prices, right? When more supply enters the market, well, that's when price comes down. It's just a balance between supply and demand, right? Adjusted home sales gross margin, that's roughly good, 28%. It's in line with what they've been doing the past couple of years. And their SG&A, so sales, general and administrative expenses as a percentage of home sales revenue, you can see that that is going to be roughly in line or even better with what we got this past year. So despite the fact that they are going to maybe lose a little bit on the average price for the home, well, their administrative expenses are down. So it should be able to compensate that a little bit as well. So nothing bad with this company whatsoever, guys. It's a very good company. The only thing, and that's what we're going to do at the end of today, of this recap right here, we're going to look at the valuation of Toll Brothers and whether or not the company makes sense at current prices. So let's take a look at their income statement. It's the last thing we're going to do. So you can see nice little bump in revenues from home sales for 2024 quarter, the quarter that just ended in relation to your Q4 from 2023. The home sales netly up 10.4%. Now, what is the cost of those revenues? Does the company have operating leverage? Are revenues growing faster than expenses? Yes, their cost of goods sold is 7.6% to the upside. So revenues growing faster than cost of goods sold, and revenues at 10.4% growth is also growing faster than your SG&A expenses which are growing at about 9%. So the revenue growing faster than both of your expense metrics means that your net income gets a nice little bump. Their net income up 25% year over year. And you can see, guys, the company does have decent net margins for the business that they operate in, ending the year with about 13.73% in net margins, which is one of their better years as a whole, guys. So really nothing bad to say about the company. That's all I wanted to show you guys. Now, in terms of the valuation, so home builders have notoriously traded at a relatively low PE ratio because that's they're at the end of their cycle right now. But as a whole, guys, you can see the PE history for Toll Brothers, regardless of its share price, has always been fairly low, usually always trading roughly around or under 10. And that's been the case pretty much ever since 2017 when the company was trading at around $30-$40 per share. So PE ratio is not really a good metric to value these home builders at. They're a very cyclical business, so their earnings are very unpredictable. That's why they don't get very, very high expected PE ratios in terms of the valuations. Usually we look at these more in terms of a price to book, and price to book ratio for Toll Brothers, meaning what is their share price in terms of their market capitalization as expressed as a percentage of the total value of the company. So if you were to take all the company's cash, all of its assets versus the market cap, what does it trade at? Well, it's only at about 1.6. Under 1 means that the company's trading for under what it's actually worth on paper if you were to sell the whole thing. So it's about a 1.6, but most of the home builders, guys, are between, 1.4 to about 1.8. DR Horton, Lennar Corporation as well. They all have roughly the same valuations now, but Toll Brothers is in a better position overall because it attracts more of a luxury segment to the market. That being said, EPS growth 8% through 2024. Their EPS for 2024 as a whole, they're about 13.31 earnings per share through 2024. So at $112, which is their current share price, it gives them a PEG ratio of just about 1, guys, which is not that expensive. But just keep in mind, after this year's growth, their growth is going to be flat. So unfortunately, we can't really value past that, right? But for 2024, let's say you want to take this trade in 2024. If we take a constant PE valuation ratio, and the math is very, very easy. If you expect their PE ratio to be roughly the same for the next year, which it probably will be, let's say we give them a 9 for the next year. Well, we just take their EPS for 2024, which is $13.31 for the end of 2024, times their valuation multiple that we want to give them, about 9 PE, right? It gives them an expected price of about $120, guys, for the future. So you see the price is about $112 right now. Their fundamental value at the end of the year should be about $120. That's why I say that this trade is coming to the end of its legs, not only because of the cyclical nature of the business and existing homes will come into the inventory later on in the year, not just because of that, but also their valuation, guys. It's really, really at the top end of the trade right now. And even analysts, guys, for the most part, their price targets anywhere between 120, which was my target as well, all the way as bullish as about 141. But you're kind of on the last leg of this trade. Is there a bit more left in the trade for the year? Potentially, yes. They increased guidance. They should have a good year. But where I get worried is after 2024. I don't believe they'll be able to keep up these same growth metrics, especially not with new inventory, existing home inventory flooding the markets, and all these consumers that have been waiting to buy homes, guys, and they're just waiting for a decrease in interest rates. That is when Toll Brothers may have a tougher time than currently. So hopefully that's been a bit of a good explanation as to the narrative behind why the home builders have been so hot and what could encumber them in the near-term future. Now, with all that being said, let's take a look into our technical analysis, starting it off with SPY. So SPY still looking for a daily higher low right now. We were targeting the top end of the trend, and we were saying, guys, if this hourly downtrend continues into today, well, daily consolidation is just underway. So the bulls are in full control. Don't get anything wrong here, but seasonality, guys, the back of my gut feeling and my analysis tells me that most likely we are going to set the daily downtrend and at least spend a few weeks into the first weeks of March having a little bit of consolidation. That being said, the bulls are still in full control. Any dip, anything above 493.64, just looking for a daily higher low for further trend continuation. The problem arises is if the bears take back too much of the move over the course of this week, they set up for the potential daily downtrend. At that point, guys, keep an eye if we lose this trend line. Stop number one is going to be your 12 EMA. SPY loves playing defense at this 12 EMA. At least it has ever since the November rally. But, right, overbought on the weekly RSI for a few weeks running now at this point. No consolidation, no more real big earnings, no inflation catalysts other than Thursday either, no interest rate catalysts. So the market right now for the next 2-3 weeks at this point doesn't really have many bullish things going for it, which is why I expect it at worst just consolidation sideways or slightly down here. And at best, well, obviously the market just disregards the hot inflation from January reports and just continues ripping higher. But as of now, guys, the bulls are in full control. Just keep a very close eye on the size of daily consolidation. If we regain the hourly trend into tomorrow, then the dip by the bears was fairly weak. We respected our previous resistance right here, which is now newfound support, and we just continue here onto the continuation of our daily uptrend. So just keep an eye if we do continue progressing into this pullback over the course of the week. How low does it come? If we take back the entire move after NVIDIA earnings, could be a warning sign for the next few weeks to come. Now moving on to QQQ, same concept. So QQQ, you can see still struggling at the top post NVIDIA earnings. So not really able to break to new all-time highs, continuously getting rejected. Now, hourly downtrend is now pretty much back to the bears at this point. So if we do continue this over the course of the day tomorrow, daily consolidation just continues. Now, QQQ, as opposed to SPY, actually did set the daily downtrend before being engulfed by the NVIDIA earnings. So now the bulls are going to be looking to protect this low with their lives, 421.68. If the bulls are looking to play defense, we will need to set the higher low, preferably around the 12 EMA right here before setting the daily higher low for further trend continuation. But if ever we take back too much of this move here, guys, after NVIDIA earnings, could be a warning sign for potential lower lows, which would just lead on to very healthy weekly consolidation here, guys. Right? QQQ still looking for its weekly higher low, anything above 396.20, just looking for a weekly higher low for further trend continuation through April, May, and the foreseeable future. So QQQ bulls still in control. Just watch the size of this pullback. It is extremely important. This week is going to be a decisive week for whether or not we really start into a few weeks of weekly consolidation or whether or not the markets are able to outpace the weekly consolidation and just go for higher highs. So keep an eye on that. Now, moving on to XLF financials. XLF still in a beautiful daily uptrend. A little bit of consolidation here today, right? So we're just looking for a daily higher low, anything above 39.32, and daily higher low for further trend continuation. Bulls in full control at this point. Weekly looking gorgeous as well. Weekly uptrend is confirmed. We're dealing with a little bit of overhead resistance right now, talking about the 40.7 region, and the next area will be 41.62, your all-time highs. So we're dealing with a little bit of overhead resistance from the all-time highs right now. Could be a good opportunity for XLF bulls to just take a little bit of a breather, but be wary if we take back too much of this move, set the lower high into lower low. Well, XLF Financials has very rarely lost this 12 EMA over the past 4 months since this November rally. So if we do lose this, coupled with a daily downtrend over the next week, it should be notable to us, and that will mark extended weekly consolidation. Anything above 37, guys, so much space for a weekly higher low for further trend continuation. So I like XLF a lot, but we'll just see, guys. Keep a very close eye. This week's going to be crucial. XLV, same concept as XLF, right? So XLV has been doing a lot of heavy lifting in the market the past 2 weeks, especially. Notice QQQ has been roughly flat for the past 2-3 weeks. But what have financials and what have healthcare been doing, right? Rallying considerably. But if everything decides to have weekly consolidation at the same time, that is when you're going to get your broader market correction. Could see SPY go down, 4, 5, 6%. QQQ maybe a bit more, 7, 8% from the all-time highs. QQQ would come down, pretty much. I've been targeting this 405 region for a decent area of weekly consolidation. And XLF and XLV will come down as well. But so far, the bulls remain in full control. Any dip, anything above 144.36, looking for a daily higher low for further trend continuation. Just look at the size of the pullback, guys. And the pullback will continue as long as the bears control the hourly trend. So just keep an eye on that, guys. If we get an engulfing move, could be lower high, lower low, flush of your 12 EMA, then we'd be looking for weekly consolidation, anything above 137.24. So much space, guys, for a weekly higher low. And your all-time highs are a very good fallback area, right? This whole 142-ish area could be a very decent area for a weekly higher low for further trend continuation. Just break out of the all-time high, sit back on it, and boom to the upside later on in the year. Good thing for healthcare. Now, IWM Russell still struggling, guys, right? Still struggling in this tightening range. Keep an eye. We do have this resistance area that we've been really battling now for a better part of the last couple of months. This has been a year and a half, almost 2 years worth of resistance for the Russell. So I keep saying, guys, we need to close a weekly candle above 201 to really be out. What I need to see the Russell do to be confident that it's finally in its expansionary run through 2024 and 2025. When will growth stocks be back? Well, when we see the breakout, retest of the zone, and then start running, guys. That would be a monthly confirmed uptrend, right? Monthly confirmed uptrend breakout higher. That's what we're looking for. So I need to see a weekly close above this level. For now, the bull's still muted at this point. Keep a very close eye this week, guys. 196.56. If you lose 196.56, set the daily downtrend and weekly consolidation just continues. It's just been a weekly tightening range using this 12 EMA as defense. Look at how many times, right? Wick here, wicks here, wicks here. Look how often it's been playing defense with this weekly 12 EMA. So if we do get a little bit of a pullback here in the forthcoming weeks, 195 should be your first target. And then we're looking down below here at about 190 to really act as your last line of defense to hold this market up. So IWM, not looking bad. But as I said, the bulls still with a lot of proving to do. You need to see them get above 204 and close a weekly candle above 201. So far, I've not been able to close those candles there. Now moving on to the Dow Jones. Dow Jones also looking fairly healthy, but just the same, consolidating, right? So daily uptrend is still confirmed by the Dow Jones at this point. Looking for the daily higher low. This current area of resistance, right? 38,800. Previous resistance should be acting as newfound support. You also have your 12 EMA confluence right there. So should be a big notable area. Should be acting as defense. Now, keep an eye, guys, over the next few days. If we lose this area, needs to be notable to us. We'll be losing a big support area. We'll be losing the 12 EMA as well. If we do get the rollover, well, we're just heading for weekly consolidation, and the Dow Jones has tons of space for weekly consolidation at this point. Anything above 37,144, just looking for a weekly higher low for further trend change. So as a whole, all of our indexes, the bulls are still in full control. It's up to the bears to prove to us by rolling over our daily uptrends. That would be step number 1 for them. That right? To be able to follow through into step 2, which is weekly consolidation. As of now, the bulls are still in full control. I'm just mindful of a little bit of sell-off because it's been 4 months of excessively good rallies and all your major indexes are overbought. Dow Jones overbought, the Russell no because it's been sideways, but XLV weekly overbought, XLF weekly overbought, QQQ still slightly overbought, SPY overbought as well, right? So just keep a close eye on that, guys. It has to be notable to us whenever they shift the daily uptrends to daily downtrends. It is going to be extended weekly consolidation. Now, moving on to crypto, going to cover crypto a little bit because we have a massive breakout coming here. 56,000 for Bitcoin. Crypto stocks were absolutely crushing it today, guys. Coinbase up 16.85%, almost 17%. Mara up 21%, and the list just goes on, guys. Crypto was absolutely crushing it here today. What I've noticed for crypto for the past couple of weeks at this point is during the weeks have pretty much consolidated, and during the weekends is when you usually got your couple little pumps. And that was pretty much the same, right? So we had some nice little rallies here back over the weekend and then into the Monday and Tuesday session, absolutely exploding. So that's what we were looking for Bitcoin, right? We were looking for the daily higher low for further trend continuation, and we got it. Now we've blasted through this 52K area of supply right now. Guys, can you tell me where the next area of resistance is at this point? It's 60,000 and then your all-time highs. We're getting very close to all-time highs on Bitcoin, guys. And the regular legacy media is just not talking about it that much. The interest is not as much as it was prior in 2021. And you can even see that. Look at this volume, guys. Fairly low volume compared to the manifested interest that we got during the 2019 rally, right? Up all the way up to the 12,000 level. Look at the volume compared to even 2017 to the first rally to 20K, right? The volume is just not there. Retail usually only starts paying attention when we break the all-time highs, the FOMO kicks in, the greed kicks in, they say, oh, now's the time that I should buy rather than buying down here, right? So just keep an eye on that. Volumes still not where they were in our previous extremely bullish cycles. So definitely more to come in Bitcoin, especially when the risk on trade happens later on in the year when interest rates come down. These cryptocurrencies are going to absolutely fly. So position accordingly. Now, in terms of your analysis, daily uptrend is absolutely beautiful. Any pullback at this point, looking for a daily higher low, anything above 50,000, just looking for a daily higher low for further trend continuation. Weekly, looking absolutely amazing too. Whenever this daily trend tops out and we get a daily downtrend, just looking for a weekly higher low, anything above 38, right? Just looking for a weekly higher low, and be wary, guys. Now, this whole level right here, 52 down to about 47, is going to be huge support to back into, right? And monthly as well. Monthly uptrend is absolutely gorgeous at this point. No red flags for Bitcoin. Tough to buy mid-rally, but my price target for the end of 2025, not 24, is about 120,000 or better. That takes in consideration the momentum that's going to happen when retail and institutions finally get around to buying it again when rates come lower. Now moving on to Ethereum. Ethereum, same concept, right? So daily uptrend on Ethereum is absolutely gorgeous at this point. Any pullback right now, just going to be for a daily higher low, anything above 2,900 daily higher low for further trend continuation. We're not going to look at the RSIs because it's crypto. They can stay overbought for a very long time. Weekly uptrend is gorgeous as well. So as soon as this daily move tops out into a daily downtrend, look how much space on the weekly, guys. So much space. Anything above 2177, just looking for a weekly higher low for further trend continuation. And the next area of resistance on Ethereum, guys, 3,500, then it's 41, and then it's your all-time high. So just keep a close eye. 3,500 resistance coming up quickly. Bulls in full control of everything right now. Now let's move on to our major tech names. So Apple still struggling down here at the $180 mark. Now Apple, the area we have to protect, I keep saying it, guys, 180. Lose 180, you set the daily downtrend, you set the weekly downtrend, but with all those major downtrends, is it that big of a deal? No. Why? Because your monthly bulls are still well in control of this chart, guys. It's still a monthly uptrend. We're just in a little bit of accumulation zone right now. Apple does this a lot where it just makes a big move up, consolidates sideways into its valuation, right? Always the same thing. Whenever Apple hits significant new all-time highs, the valuation always comes into question. They consolidate for a little bit and then just continue on pushing north. No red flags for Apple. As a matter of fact, anything below 180, preferably 175 to 165 is my sweet spot buy zone. We have overhead. We have now, it's used as support, but was previous all-time high resistance, newfound support back in the last fall sell-off here. So I do expect this area to play as big support for your bulls as well. So I will be buying Apple as long as we continue dipping. If we dip below 180, I will be playing Apple shares this entire way down because I don't really believe it's going to go lower than 166 in the event of a broader market sell-off anyways. So that being said, right, bears, short-term control, looking for the daily downtrend flush. If that does happen, like I said, guys, let's go shopping around 175, 170 for the best possible prices. If the bulls want to reverse this, they have to put a stop to this bubble bottom right here and then crack your highs right here, 185.09, reset the daily uptrend, and then your weekly lows will be set, and then we'll be looking, can we crack to the upside, 195.80 to regain the weekly uptrend. So Apple, I mean, not looking bad, but not looking the best either. Right there in the middle, accumulation by territory. Now moving on to AMD. AMD consolidating sideways as well. So AMD has been stuck in this range, pretty much over the past 5 weeks at this point. So really easy range, guys. 185 to the upside, and to the downside, it's your previous range of all-time high, right? Your 164 to 168, 158, previous all-time highs, currently acting as support. And we're just allowing the market to catch up to the price pretty much. You can see here, the weekly RSI still overbought, but the 12 EMA now catching up to the price ever so slightly, now also within our area of support. And on the daily, ever since this sideways consolidation, we went from overbought conditions to roughly flat right now. So AMD, really tough to determine price action at this point. Semiconductors as a whole have been extremely hot and should, in my opinion, be one of these sectors. If we were to head into weekly consolidation into the markets, I do believe that semiconductors do have the most in terms of a give back potential. Semiconductors, if we expect, look, whenever it pulls up, pulls back to the 12 EMA, pulls up, pulls back to this 12 EMA, right? It really hugs this 12 EMA or pulls away from the 12 EMA, then goes sideways until the 12 EMA catches up, right? So if we do see a pullback, we could be expecting a little bit of a pullback to the 12 EMA. Semiconductors, maybe about an 8-9% drop to the downside when that happens. Very volatile industry. And if that happens, guys, AMD is not going to be spared. We're going to be looking to the lower end of support down here, 164 to about 158 as previously stated. As a whole, though, the bulls looking healthy. They're trying to set up the daily higher low for the break. Just continue this weekly beautiful bull flag into weekly bullish expansion. But tough for me to buy up here, guys. My preferred spot to buy AMD at current valuations is currently about 150 down to about 140. Now moving on to Amazon here. Amazon looking decent, 0.15% of the downside to today, but we did set a higher high on the day. Still not able to break our overhead resistance. Overhead resistance is about 177, then the all-time highs about 188. I love the fundamentals of Amazon into 2024. They should be bringing in record amounts of free cash flow and very decent profit margins as well while growing their business. No red flags at all. Bulls in full control. Any dip right now, just going to be looking for a higher low, anything above 165.77, daily higher low, and then potentially make an attempt here at this big overhead 177 resistance. In terms of the weekly bulls in full control as well. We got the weekly higher low. Now we're looking for weekly higher highs. So no red flags at all on Amazon. The red flags, well, I mean, red flags, they wouldn't be that big, but if we lose this 166 zone to the downside and we set the daily downtrend, recapturing the earnings gap, just looking for extended weekly consolidation on Amazon would be very healthy. At that point, guys, I'm looking for 160. If I can find 160 on Amazon, I'll be loading up myself. Now moving on to Google. Google with a terrible day today, down 4.5%. What happened on Google, guys? Well, unfortunately, their Gemini AI software is not working as planned. Now take a look here. Google to relaunch Gemini AI picture generator in a few weeks, following mounting criticism of inaccurate images. And this was actually, I mean, it's funny, but then there's a certain part that's not funny as well, and I'll explain down here why, guys. So after pulling its artificial intelligence image generation tool on Thursday, due to a string of controversies, Google plans to relaunch its product soon. So they pulled it off the market. This is their image generator software, a bit like Midjourney, a bit like plugins from ChatGPT work, where you type in prompts like, draw me a picture of a cat in a backyard or whatever, and it'll generate you an AI picture of a cat in the backyard. That's what this does. So here it's called their Gemini service. Used to be called Bard, but now it's called Gemini. So here's the thing, guys. The controversy follows a high-profile rebrand Google announced earlier. The controversy follows a high-profile rebrand Google announced this month when it changed the name of its chatbot and rolled out a fresh app and new subscription options. The chatbot and assistant formerly known as Bard, a chief competitor to ChatGPT, is now called Gemini, the same name as the suite of AI models that power the chatbot. Okay, that's all good. But what happened? Well, they pulled their product last Thursday and they got some further criticisms today by analysts saying, well, are they too behind the AI curve right now as opposed to companies like maybe Adobe or Microsoft in terms of their AI generation, not only for text, but also for images? Well, here's what happened. When one user asked Gemini to show a German soldier in 1943, the tool depicted a racially diverse set of soldiers wearing German military uniforms of the era. Now, if you don't know what that means, this is the prompt. Generate an image of a 1943 German soldier and look at the results that it came out with. This is why I say it's funny, but it's not so funny, right? It's a real concern for the business. I personally find it funny, not the actual prompt, but the results that it's giving, trying to be more diverse and whatnot. Obviously, Google trying to be more diverse in terms of its inclusivity, and this was one of its major criticisms. When asked for a historically accurate depiction of a medieval British king, the model generated another racially diverse set of images, including one of a woman ruler, screenshots show. So these were another set of screenshots that you can see on Twitter here, right? So paint me a historically accurate depiction of a medieval British king, right? So it's... not the best, right, guys? Not the best. So the Gemini debacle showed how AI ethics wasn't being applied with the nuanced expertise necessary. Last year, Sundar Pichai, the CEO, was criticized by employees for the company's botched and rushed out rollout of Bard, the same system we were looking at. The latest problems with Gemini have reignited a debate within the AI industry, with some groups calling Gemini too woke or left-leaning, and others saying that the company didn't sufficiently invest in the right forms of AI ethics. Now, the controversy isn't limited to Gemini's image generator. On Sunday, a text-based prompt went viral asking the Gemini chatbot whether let's just say, because I don't want to hit some YouTube keywords, or Elon Musk's tweeting of memes had a greater negative impact on society. Now, this should be a no-brainer, right? But apparently not for Gemini. Gemini said, it is difficult to say definitely who had a greater negative impact on society, Elon Musk or this figure right here, as both have had significant negative impacts in different ways. Not the best answer, guys. Google said in a statement Wednesday that it's working to fix Gemini's image generation issues, acknowledging that the tool was missing the mark. The following day, the company announced they would immediately pause the image generation of people and re-release an improved version soon. So that's what's happening with Google, guys. Is it a determining factor for the business? No. Is it going to change their revenue substantially? No. Is it going to change their profit margin substantially? No. Is it going to change their dominance in search and advertising? Absolutely not, guys. It's a non-factor. It's a buying opportunity for the business. Short-term catalyst means long-term buying opportunity for me. So Google, 4%, 4.5% drop on the day here today, down to about 138.75. And in the process, we were looking at this tightening range potentially playing out into a daily downtrend. Exactly what happened. Daily downtrend underway right now. We're going to look to the bottom end of the support area, 138 at this point, almost there right now. It's big previous resistance, current support for the stock right now. And your support after that, guys, falls down into the mid 130 zone, right? So about 130 to about 134 is your next big area of support. This is this whole area right now. Very solid support as well. We would like to see this one hold, but if it goes down all the way to here, I'm going to buy even more. This is my first buy target for Google, second buy target for Google, and for every which reason we get to 128 down to 120, this is like, back up the truck for leap call options territory down here. I'll probably throw a couple if we go to 134, but this right here is like, it gets really juicy, guys, all right? So just keep that in mind with Google. Really nothing negative to say about the company other than its most recent headlines, right? As a whole, company's still looking good. Daily downtrend confirmed. Just need to protect this low right here, 138. If we lose that, guys, well, unfortunately, we will lose the weekly uptrend, and we'll just be into a little bit further monthly consolidation. But you can see here, long-term bulls are in full control. Anything above 122, just looking for a monthly higher low for further continuation. So I have played Google this week in the 138 region. If getting assigned, I will be very happy to own shares of Google at this price. Valuation is very low. Forward price to earnings is about a 20 for 2024. So very good. One of the lowest valuation stocks in the Magnificent Seven. So I love Google. Just keep an eye, guys, for these lower price targets. I am expecting 138 to hold and expect Google to rebound nicely. But if for every which reason the technicals deteriorate and the rest of the market also deteriorates, and we go back down to the mid 130s, guys, just want you guys to know it's an even juicier buying opportunity for me. Now moving on to Meta. Meta looking good as well. So Meta was down 0.47% on the day, but not so much that high, that far off their all-time highs, right? So daily uptrend still confirmed. Just looking for a daily higher low, anything above 461.25. Daily higher low for further trend continuation. If for ever which reason we take back too much and set up for the daily downtrend, Meta has so much space on the weekly, guys. Just looking for a weekly higher low at this point. Anything above 340. Just looking for a weekly higher low. And even Meta, guys. Meta on a forward basis, their PE ratio is fairly good. Actually not that bad. as a whole. If we take into consideration their 2024 EPS at their current share price, right, take a look at how Meta, you think Meta is expensive. It's actually not that expensive, right? So about 482, let's call it, divided by 19.9 earnings per share, trading at a forward PE ratio of about a 24. Not that bad, is it? So that's why I say if we get a little bit of correction down here, 420, I'm really looking for the downside. Upside targets remain 500 psychological, but to the downside, guys, if we can get, 420 or better on Meta, that's when I'll be playing Meta personally. But so far, so good. Bulls still in full control. Moving on to Microsoft. Microsoft down 0.68% as well. Consolidation, right? So Microsoft had set the daily downtrend. That was strange for Microsoft. Microsoft had not set the daily downtrend since pretty much last September, but they did it over the past 2 weeks. NVIDIA earnings obviously erased that, but if we take back too much of this move, we will be looking for continued daily downtrend and continuation of weekly consolidation on Microsoft. Now, it's a good thing that the bulls have a lot of space. Anything above 366, just looking for a weekly higher low on Microsoft for further trend continuation in 2024. Who is in long-term control? Well, it is your bulls. Even some weekly consolidation into a March red candle maybe will just be very healthy monthly consolidation on Microsoft. So just keep that in mind. So far, so good. Bulls still have a little bit of space. We're looking for a daily higher low, anything above 397.40, daily higher low for new daily uptrend. But if ever they fail because the markets go into extended consolidation, just know that it's very healthy for Microsoft. I'm looking personally, guys, 385 to about 375 is my sweet spot for playing Microsoft in the future. Now moving on to Netflix. Netflix struggling a little bit as well, 0.7%. You can see how much Netflix has been struggling in this relative area. That's because it's a very big resistance area from 2020 and 2021. This 575 mark is absolutely crucial for the company to maintain above. Now, because of how lofty the markets have been, it's been tough for Netflix to really push those levels, right? And usually you expect when companies break these levels, they continue to rally, but not in the case of Netflix. So Netflix, the key level is last Wednesday's low, 567.69. Break that to the downside, guys. You end up with a daily downtrend. You also end up with a bit of weekly consolidation. Netflix, personally, I'm looking for 520 or better to play this one if I ever had to play this one. Although the bulls are looking very, very decently set up right now, you would not want to come back under this 575 level. If you come back under 575, it opens up the door for the bears to use this as resistance and just perpetuate a daily downtrend and continuation of weekly consolidation at that point. That is going to be the buying opportunity that I'm looking for. If we can pull down 540, 530, I'm writing probably the 520, 510 puts on that one. So Netflix looking good. Upside targets of resistance right now, still 623. Now moving on to NVIDIA. NVIDIA trading just under $800, still 0.35% to the upside, but sideways consolidation inside Friday's trading, right? So setup is still the same. Any pullback, just looking for a higher low, anything above 660. Higher low for potential further trend continuation. Previous resistance, right, is going to be newfound support, and your 12 EMA is curling into this area nicely. So could have a little bit of confluence if we do pull back there. The red flag arises if we lose this area. The bears will take back too much of this move, could open up the lower high, lower low. At that point, NVIDIA would just be due for a little bit of weekly consolidation, anything above 474, just looking for a weekly higher low for further trend continuation. No red flags for the business whatsoever right now. Little bit, however, of divergence, right? So a little bit of bearish divergence on the stock. So could be expecting this to correct in the direction of the RSI, namely a little bit of a pullback. So we'll see how much NVIDIA gives back. But so far, so good, guys. Not looking at no red flags for the stock currently. And now lastly, let's take a look at our three last ones here. So first, we're going to do Tesla. So Tesla looking very good on the day, up 4% on the day. Beautiful little recovery by them. We were keeping an eye out, guys, if we were to lose last Tuesday's low, right? 189-ish. That would set up a daily downtrend. It would be the end of this weekly push higher, and we would just maybe heading for weekly lower lows at that point. But the bulls putting up some good defense. I still need to see them break above 203.05. Break above 203.05. Your daily uptrend resumes. We're targeting the overhead levels pre-earnings 207 all the way up to about 212. This is the next area to recapture, and we are looking for the bulls to continue this weekly bounce. For this weekly bounce to be healthy, to give them a shot at a new weekly uptrend, guys, we need to get as high. I've been saying this for a while now. We need to get as high on this bounce, 220 to 230, which means we need a daily uptrend all the way to 220, 230. That will be your weekly bounce. It gives the bulls enough space for a weekly higher low to start trending up into the later part of 2024. As I've been saying, I think Tesla is at the bottom of its cyclicality right now. It's at the bottom of its low demand cycle and should be looking better into the end of the year when rates start coming down and Tesla is not forced anymore to continuously reduce prices. So we'll see how that stands. These levels are crucial, guys. 203.21 for the continuation of the daily uptrend into a potential bounce to 220, 230 for the weekly bulls to start taking over. If we lose these levels, however, we're going right back down, guys, to our major support levels on the weekly, which is between 170 to 180, crucial zone of support, and is also the confluence of your downtrending channel line as well. So just keep those levels in mind. If we do trade lower into 190, mid 180s, I love playing these Tesla 180, 175 range short puts. So just keep that in mind for Tesla. And now lastly, our two last ones, Palantir and PayPal. So Palantir performing well on the day, but we're still watching for the potential of the daily downtrend. A loss of 22.22 should be a daily downtrend confirmed by the bears and should just be a continuation of weekly consolidation after a beautiful earnings period for the stock. If we do continue consolidation, well, 21.50 down to 20.5 is going to be a likely area of pullback. It is your previous area of support from back down here after the IPO and also previous 52-week highs over the past year. So this is the breakout retest of the zone and looking to rally further. Obviously, if we set the lows right here and just break out into a new daily uptrend, upside targets remain 25.48. And after that, guys, we're looking all the way as high as $28, the top end of that range right there. So Palantir, not looking bad whatsoever. I just need to have a little bit more price downside to possibly write some short puts here. 21 all the way down to $20 range is my new buy spot for Palantir for that. And now lastly, PayPal, guys. PayPal up about 0.29%. PayPal still struggling in this range, so the analysis remains the same. If we lose the 57 area, it is daily downtrend and also weekly uptrend is lost for the bulls. This area is so crucial on the weekly, guys. Can't stress it enough, right? They have never closed a weekly candle below 57 in this entire weekly uptrending cycle for pretty much the last 4 months. So if we do close a candle below there in the forthcoming weeks, it should be notable to us. The downside targets after that go proceedingly to about 54 and then all the way as low as about $50. That's why this area is so crucial to be maintained. It also keeps the bulls in relative striking distance to your overhead channel line, right? This downtrending channel we've been in for almost 2 years at this point. Well, crack this to the upside and you can really start gaining some more momentum for your longer term bulls looking to buy these dips. It'll send off a lot of alerts for technical traders, both retail and institutions alike. So that's what we need to see, guys. Need to really see next steps for the bulls. Mount this $60 range, which is 60 to 57, the range that we've been stuck in. Mount it, use it as support, and the next leg up needs to be a crack of this line here, which currently stands at roughly $62, $63. So those are the things that PayPal needs to do. But if we drop it to the downside, I will be looking to buy more PayPal shares. Anything under 57 for me is starting to look like short put territory. So I will, as long as we get close to this area, guys, I'll be writing the 57s, 56, 55. Really don't mind being assigned in the high 50s. And then obviously if we keep plummeting, well, my second average down is going to come in roughly at the $50 range. I love the valuation down here on PayPal. And now lastly, guys, for the subscriber request, we're going to look into SMCI. So SMCI, if you don't remember, we did cover them for their earnings. I erased the fundamentals on earnings, but I did do a video on them a couple weeks back after their earnings saying specifically that the company did have room to move. I would not be surprised if the company would continue running after earnings because of how decent their valuation was as a whole and the fact that they're part of the whole AI and semiconductor chip hype, right? But as of now, guys, it's just a big tightening range. So if you want to look at this, guys, in terms of simple technicals, this is pretty much one move higher ever since this little move after earnings right now. It's one move higher. So daily bulls are in control. We have the daily higher low. The bounce was good. We're looking for the perpetuation of the tightening range. This stock is going to be entirely dependent on the movement of semiconductors as a whole. I do believe that in terms of SMCI, especially since we don't have NVIDIA earnings anymore, no bullish catalysts, a lot of them are starting to get a little bit overbought on the RSIs. You can look at ARM as well. So ARM as well, right? ARM, keep in mind, ARM has their lockup period expiring for pretty much the mid-March period. So there's going to be a lot of shares that SoftBank is going to be able to sell. But a lot of these companies looking exactly the same, right? They're getting to the end of this current cycle. Now, could they have some weekly pullback here? Potentially SMCI pulling back to maybe $700, setting the weekly higher low, and then continuing this trend into the next year because of how hot the semiconductor industry is as a whole? Yes, absolutely. So that's why it's very tough to predict where this one's going to be going right now. In terms of valuation, guys, at about $876, right? Very, very easy. We just take their forward PE ratio, which is about $21.68 for the forthcoming future. So let's just call it 21.68. So 876 divided by 21.68 is about 40. So 40 is a little bit lofty, but if I do remember correctly, this company is an extremely fast growth rate as well. SMCI EPS growth rate future. Sorry, I should have this on the chart here, guys. So EPS is expected to grow by about 27%. So if you take this 40 PE divided by 27, it's still only about a 1.5 peg, which is really not that bad, guys, even at current valuations right now, which is why people are still buying it right now, right? So very decent technical pattern right now on SMCI. What you would not want to see, guys, is losing this tightening range right here. If we lose the 828 right now, we're going from a tightening range to 4-hour bear control and potentially just setting up for further daily consolidation. If we set something like this, guys, then most likely we are going to head to $700 at that point, right? A little bit of weekly pullback, but you will find all of your bulls down here at the $700 range ready to buy that dip for the weekly. Also probably if this starts off in the month of March, could just be a monthly pullback for some extended buying after that. Now, would I be buying this company out here? Probably not here, guys, right? If you have some shares from all the way back here, we're talking $500 and under, it's a no-brainer hold over at least the next year, year and a half, in my opinion. Valuations right now, although they are a little bit stretchy, it's not that bad. So I would just be holding. Initiating a new position here, guys, wanting to get a little bit like a 1.5, 2x, a little bit risky in my opinion, if I'm telling the truth. But that being said, they're part of the industry. If any industry can do it, they can probably doing it. It's just a fairly risky trade, guys. I would much rather, if you are going to go for that trade, I would much rather do it at 700. But even at 700, it's a little bit rich, right? It's just a little bit rich, but it could be nice for a little bit of a weekly pullback into weekly uptrend. The bulls are in full control right now, that's for sure, right? So that is what you're basing it off of. Continued hype in the semiconductor narrative and just the bulls remaining in full control of your longer term timeframes as a whole. So hopefully you guys enjoyed that. Now let's take a quick look into my portfolio and that'll be it. So taking a look at the positions, guys, thank you very much for watching all the way through to the end. I know the video is long, so I will keep these quick. So Rivian, we got assigned 300 shares last week, some at 12.5, some at 12, all together with the net credit and everything. Our average cost is about 12.11. So I took advantage of a little bit of a 6.25% increase today on the share price, right? To write a little bit of covered calls for the remainder of the week. So we wrote the 11.5 calls. Now I know this is under my strike price, but if ever we do get above 11.5 on the week, which would severely surprise me as a matter of fact, well, I'll just be rolling these forward, guys, and we should be able to bring our break even down. So with this cost, it brings our cost on Rivian to just below $12, about $11.98, something like that, right? So we are in the $11 range. The reason I didn't wait until it was a 12 or 12.5 is because there was just no premium on those. I went with the 11.5, so you can see the expected move for Rivian by the end of the week is just under 11.5, about 11.37. The company's already ran 6% on the day today, so another 6-7% to the upside could be highly unlikely, but I hope for it if it does happen. But if it doesn't, we'll just collect that covered call premium. And if it goes above, we'll just have to roll forward and that will be it for that trade. So fairly conservative position on Rivian. Now we did write these Caesars 39.5 puts. They were featured in my video yesterday. We got about 27 cents for them on Caesars. So Caesars, just a quick reminder, we're just always looking to play this lower $40 range. If we can get below $40, perfect. So the expected move on Caesars for the week was about 40.15. And as I was saying, we were looking for 39.5s. So wrote those for the end of Caesars. Very beautiful weekly bottom support range. Now moving on to Unity. Took an earnings play, guys. for Unity at about the 25 puts. So just want to show you guys that I'm always taking these roughly under the expected move. So Unity, that's not the ticker for it. So Unity Software, the expected move prior to earnings. Prior to earnings, they closed at $33. Expected move was about 14% for about $28 to the downside. I went under that. I went with the $25 range, which is the lower end of this range here, guys. And you can see in the after hours, the stock is currently trading down to about $26.77. If I get assigned shares of Unity, guys, at $25, I really won't mind. It's the bottom end of their all-time lows pretty much. And I love this company for what they do. If you don't know what they do, we'll tackle it a different time. But one of my favorite software companies, they just haven't been getting a lot of love recently because they are unfortunately net income negative still. But I love the company for what it is when not being assigned down there. Mine being assigned. So we wrote 2 contracts at the 25s. We got about 19 cents for that, so almost 1%. Apple 180s, another trade featured on yesterday's video. We took the Apple 180s for about $1.03 after Apple sell-off today. So we're just looking for any short puts that we can, 180 to 175. I went with the 180 specifically. The expected move is 179.46, but there was just not enough premium at the 177.50s. So I went with the 180s. Wouldn't be mad being assigned at Apple for 180 anyway. So we got over 0.5% on that one. Baba, 79 calls. We got about 0.5% for those as well. 40 cents, 79 calls on Baba. My average cost on Baba at this point, I have to update it. Sorry, I didn't update this number. This should be about $77.60-ish right now. So it is above our current break even. Just looking for really Baba to stay under $79. If they do close above $79 by the weekend, we'll probably roll these calls, but very, very good price improvement here by Baba as well. So looking good in terms of those covered calls and managing the position. We also took another earnings play for tomorrow morning. This is 4, so we're going to look at that. We got the 60 puts, but keep in mind, these are for March 15th. So there's still about 3 Fridays away, and we got about $1.47 for it. So about 2.5%. But since they have earnings, a lot of the volatility should come out of this stock by that time here, guys. They don't do weekly options. They only do monthly options. So the $60 put is where this red line is. This is Shift 4 Payments, a company that Michael had brought up previously on the channel before. Very, very solid company, not the industry leader in terms of what they do, but very solid numbers for the company. They do generate positive net margins. Revenue expansion is great. So I'm looking for that little bit of a discount, guys, playing off this previous support area in the $60 range. And that was a decent amount of sell-off here, guys. So we'll see what happens tomorrow morning, but that would be a sell-off of about 17-18% down to $60 here. And if we take a look at their expected move by the end of that contract, even in the next 3 weeks, guys, with earnings tomorrow, they're not expected to move much below $60. So you can see that even in 3 weeks, $63. So if 4 opens flat or up or slightly down tomorrow, most of the value of this contract is going to come right out, and we'll be able to close these at a profit. Now, we did write the Google 138s as well. So that should be notable. As we said, Google, anything 141, 138. Well, I wrote Google pretty much a bit earlier in the morning when it was still trading in the high 139s. We got the 138s for Friday. Wouldn't be mad being assigned. We got about 90 cents for those. So well over our 0.5% rule. Very, very good. Workday. We also took another earnings play on Workday here. Workday, the 270 puts for 234, almost 1% here. And it was a significant ways away after earnings. So their earnings came out today after the close. They literally went down to about $282 right now. So we should be safe for the week. I targeted the 270s. 270s is roughly this breakout from your all-time high zone right here. So we're just looking for pretty much the monthly breakout and potentially retesting of this area of your previous all-time highs. Like, look at this beautiful area, right? Breakout, potentially retest and run. Workday, extremely good margins, revenues going up, very solidly run company. Nothing bad to say. The expected move on this one was about 280 if I'm not mistaken. So you'll see the expected move was roughly down. They were trading at 307 before earnings. Expected move 281. So we went with the 270s being a little bit conservative. And since they're roughly about 280 right now, we should be able to get some good value on this contract as well by the weekend. Would not mind being assigned on that one either. The Applied Materials 210 calls, still have those open, looking to close those in the next few days. TMF as well still have the calls and the shares open. This is the 3 times leveraged 20-year bonds. We have a new little swing trade on ACAM because some of you guys don't have the required portfolio size to make to run the put wheel. So I figured I should include a little bit more swing trades that I don't do that often, but I'm going to be doing more of them just for educational purposes for the swing trades here. So we have a beautiful area. 200-day moving average is right down here for ACAM. oversold conditions. What we're looking for here, guys, is the bulls recapture of the hourly uptrends. We'll see if they can maintain that. The stop loss goes below these lows, 106.52, and the take profit, guys, is going to be roughly at your previous area of support, roughly coinciding with the moving averages to about 114, 115. So we're looking currently, we took them right around the 108 area. So we have about $6 of upside, and about in terms of the downside risk, only risking about $2. So it is a 3-to-1 trade, just looking for the daily lower high off of oversold conditions. ACAM doesn't hit oversold conditions that often. When it does, it usually tends to have some pretty nice rebounds out of those areas. So we'll be looking to stay in this trade only for potentially 7 to 10 days. It's going to be a nice little swing trade. Didn't take it with too much size, just to show you guys that even with $2,000 in value of a position, we can still look 2-to-1 risk to reward trades, 3-to-1 risk to reward trades, right? So we'll see how it plays out. Looking to fairly decent on this one. And it's a very good company as well, guys. In the grand scheme of things, right? ACAM has been maintaining these highs for a while now. We're coming up on the monthly moving average as well, and you can see it's just been trapped. 102 is pretty much the lower area of this wide range right here, here a couple times in the past, right? So that's what I'm kind of targeting right now, plus oversold conditions. We're just looking for this to be the daily bottom and the start of our daily bounce as expressed by the gain of the hourly trend today. So we'll see, looking a little bit dicey. I took it up here during the day, but still decent. We're not yet losing that hourly trend. We'll see what happens into tomorrow. It's any which case, guys. The stop loss is pretty much down below here at about $106. So looking good on that. ETH and Bitcoin still have those. Nike, not high enough for covered calls. BABA, we went over it. GDXJ, not high enough for covered calls just yet. Rivian, we talked about it. And my Canadian banking shares pulling back a little bit today, but still looking good. So that's pretty much everything for the portfolio. What we have going on for the week. Obviously, we'll keep you guys updated if I do make any more trades intra-week, but looking good. Only used about, for all those trades, only used about half of our buying power. So we still have a lot. If ever the market drops tomorrow, I'll be looking to shop even more. That's why I only wrote one contract on Google. If it keeps dropping, we'll just throw another one at it. So hope you guys enjoyed that. Take care as usual. If you have some time, consider dropping a like on the video. Would really appreciate it. Consider subscribing to the channel if you're new. And as always, if you have any questions or requests that you want me to look at on the channel, leave them down below on the comment, and I'll try to include them in a video in the short-term future. So take care, guys. See you tomorrow. Peace.